Hey, cash flow maximizers. Today we're going to talk about IUL versus whole life. IUL is indexed universal life insurance. Whole life is whole life insurance. Specifically, we're going to be comparing overfunded, specially designed high cash value policies. So when I go through these comparisons, keep in mind, this is not your run-of-the-mill indexed universal life insurance or whole life insurance. Yeah, if you're not sure what I'm talking about, check out my videos on indexed universal life insurance. And you can also check out our videos on whole life insurance and the infinite banking concept.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So let's jump into this. The basics are we're designing life insurance policies to maximize cash value and minimize the insurance cost. As we go through these, you'll see why we tend to choose one over the other in specific situations. So starting out, Index Universal Life Insurance uses annual renewable term. Annual renewable term is the cheapest type of term insurance available. It's the cost of however much you're going to insure yourself for 1 year. Now, I should actually clarify, it's the cheapest life insurance out there when you're young. As you get older, the annual renewable term cost goes up. But the key part here is the underlying insurance for Index Universal Life Insurance is annual renewable term. With whole life, it's similar to level term in that it takes the whole term of your life and then it breaks it down into how much is it going to cost for each year. So it's not 20-year term or 30-year term, which you'll find is still fairly inexpensive insurance, but those are designed to end before you actually pass away. So that's why they're inexpensive insurance. Whole life insurance will be there when you die. So eventually it's going to pay out. So you're not going to see the really low prices that comes with term insurance, where only 1% of those policies end up paying out. So term insurance happens to be the most profitable type of insurance that companies offer because it rarely pays out. So next we have Index Universal Life Insurance has a lower insurance cost when you're young, but it does increase substantially past age 65 to 70. This is just the nature of annual renewable term. And part of why we like Index Universal Life Insurance for the performances that it offers is because we get it when we're young and the cost is cheap. As we get older, we've already made the gains that we're going to make on it. So as that cost of insurance increases, we're going to look at other options. Compare that to whole life insurance, and you have guaranteed insurance costs, what we call static payments. So the payments are going to be the same year after year after year. They're not going to increase. Okay, back to Index Universal Life. Growth in your Index Universal Life policy is based on a stock market index, typically the S&P 500. It has a 0% floor, which means you're guaranteed not to lose money in these policies if the market goes down. But growth is also capped at 4 to 16% based on your contract. So when the market goes down, you have a floor of 0%. It won't go past that floor. However, when the market goes up, you're going to have a cap. So ultimately, it's going to stay between the floor and the ceiling the whole life of the contract, which ends up working out pretty good. It turns out if you get rid of all of the losses and you only take advantage of some of the growth, you end up in a pretty safe situation on average to get growth, and you don't have to worry about market losses. So it's a really great option for folks who want to have the opportunity to increase their growth, but not so much that they're willing to risk everything. Whole life, on the other hand, growth is based on dividends. You are a part owner of the company, and you are going to get paid dividends based on the profits of that company. So rather than it being based on a stock market index, you have a guarantee of 4% on whole life insurance contracts, and you get growth based on dividends. So this brings us into this next column, which is in the index universal life, growth is not guaranteed. This is why we have a 0% floor. So if the stock market that you are indexed against loses money, you will not get growth that year. In fact, after you factor in the cost of the insurance, your growth could be negative that year, but only that slight bit for the cost of the insurance. So your growth is not guaranteed in an index universal life, but your growth is guaranteed with a whole life policy. And that growth is guaranteed 4% or whatever your dividends were. Typically, that growth on your whole life policy is guaranteed to be 4% or whatever the dividend is. Now, because of those reasons, you actually end up with higher potential growth than whole life with the index universal life insurance. This is where the popularity of these products come in. We try not to view life insurance products as investment vehicles, so we don't treat them as such. I view them more as savings type assets, but an index universal life policy, in my opinion, is a good alternative to something like a Roth, in that you do have market-like growth potential from the index universal life due to the performance of the stock market index. So it is a good alternative if you want to have a safe investment type vehicle. No life insurance is considered an investment, but this is about as close as you can get without having the risks of the stock market on your shoulders. Now, whole life insurance, on the other hand, a lot safer. You have a lot of guarantees. There's a lot of guaranteed growth, but it is a lower potential growth than what you can get with the IUL. And that's just based off of historical year-to-year averages. Now, of course, a life insurance company could probably have a breakout year and earn investment-like returns that you see in an IUL. It's just not historically how it works. So we do end up having a lower potential growth with whole life insurance than we do with IUL. Moving on, the low cost of insurance in an IUL in the early years provides greater opportunity for cash value growth than whole life. Whereas whole life, you do have a higher cost of insurance. This limits the growth opportunity within the policy. There's no way to get around that. And regardless of how we design these policies, what it comes down to is the lower we can get the insurance cost, the greater the opportunity for cash value growth. The way we design these policies, regardless of which one you get, we do minimize that cost of insurance. But the fact remains, whole life insurance is based off of the actual insurance cost for your whole life. And index universal life insurance is based off of annual renewable term, which means we're going to have lower costs in the beginning for index universal life insurance. So with index universal life insurance, we say it's great for retirement type growth goals. There's minimal risk. Again, you do have a risk of not earning any growth that year, but you have the opportunity to earn more growth than you would otherwise. And some of these policies can work for personal banking systems, but it is more risky than whole life. So for the most part, when we talk about doing infinite banking, we talk about whole life because it has the best guarantees with the lowest risk, which makes it ideal for personal banking systems. You really want to have that low risk that comes with a savings type asset and not an investment grade policy that is designed to try to maximize the growth. When it comes to the infinite banking concept, the value in that comes from taking banks out of the equation and borrowing from the policy and paying back yourself, knowing that you're going to get that guaranteed compound growth for the rest of your life. It's that guaranteed compound growth that makes it all worthwhile. When it comes to the IUL, it's not guaranteed. So when you take away those guarantees, you kind of lose a little bit of the value in that. That doesn't make them bad products. I want to clarify, it does not make them bad products. It just makes them different. They serve a different purpose. Now, with an index universal life policy, you are not an owner of the company. So there's no dividends that get paid out to you. This is why there is no guaranteed growth. It is strictly based on the stock market. Anytime you buy a whole life policy from a mutual company, you become a partial owner of the company, which means any profits that the company makes, dividends get paid to you on top of or above that 4% guaranteed that's in your contract. Now, the cash value growth is best for an index universal life policy if you begin it during the ages of 0 to 45. So when we start an index universal life policy, because it serves a similar purpose as a Roth, you need to have time for it to perform while the cost of insurance is low. So it is definitely best if you start these policies before about the age of 45. After the age of 45, the cost of insurance starts to go up. It's definitely higher than we would like it to be. And it just makes it harder to offset the cost of that insurance and take full advantage of the growth that's available. So what I've noticed is we're definitely better off looking at whole life insurance policies once we get past that about 45 age, because there's a lot of value still in infinite banking concept utilizing a whole life insurance product that you just will not get from using an index universal life product. And this is because the cash value growth is similar at any age. So when it comes to the design of these whole life policies for the infinite banking concept, the cash value growth is very similar. It doesn't matter if you're 55 or if you're 25 or if you're 35. The only thing that changes based on your age is how much death benefit it's going to buy you. But we can still get similar cash value growth, which is disconnected from the death benefit. Another thing to consider is that surrender charges affect access to early cash values. Index universal life policies, you don't end up having the same amount of access to your cash value in the early years as you would in a whole life product. In my index universal life policy in particular, I didn't have access to it for the first year. On top of that, there's still surrender charges going out 10 years that reduce the cash value that's going to be available. Now, in my situation, I was okay with that. It worked out well for what I was trying to do, and we're in this for the long game. So those surrender charges, not really a big deal. I do have access to enough cash value, still well over 85% once I get into the second year, even with those surrender charges. So as long as you know what you're getting into and you know what to expect, it's not really a big deal, but you need to be aware of it. This is a difference between IULs and whole life. Whole life insurance, no surrender charges. Your cash value is going to be whatever your cash value is going to be. This next one gets into why there's a little bit more risk with your index universal life policy than there is with a whole life policy, because your policy may never be fully funded with an index universal life policy. What that means is because you're paying for your insurance annually and the cost is going to go up every single year, your policy actually never becomes fully funded. The next point in here is the only way we can actually fully fund it, and that's using an overloan protection rider. But we'll get to that in a second. Whole life policy, your policy can be fully funded at any point after, well, your policy can be fully funded at any point, really. Let's tie these 2 points together. We've got An index universal life, your policy may never be fully funded unless you have an overloan protection rider. The overloan protection rider ensures access to cash and it shuts off the premiums that are due. It's typically available after age 65 or 75, depending on the policy that you get. Different carriers have different rules for their overloan protection rider, but it is essentially the same as what's available in a whole life policy, which is called a reduced paid up option. The overloan protection rider is similar to the reduced paid up option in a whole life. Now, the reason we say a policy can be fully funded at any point in a whole life policy is because you can trigger a reduced paid up option after policy year 7, and that turns off the premiums. You might say, wait a second, you said my policy can be fully funded at any point. That's because let's say you put in a large amount into your policy in year 1, you can actually go without making any more payments till year 7 and then turn off the premiums. So essentially your policy was fully funded in year 1 because you put enough money into it. So that can work out in any of those other years, just like in year 1. After year 7, though, you can really turn it into a reduced paid up at any time. And what that does is it just tells the company, hey, we're done making premium payments. However much my cash value is right now is going to be however much my death benefit is worth. What they do is they say, okay, we're going to turn it into a reduced paid up. You can no longer make any premium payments. Everything else will be the same. You will still have a death benefit. You will still be able to borrow from the policy, and you'll still be able to pay back those loans from the policy. It just makes it a more efficient policy because you no longer have premiums due. Now, with an index universal life policy, the optimal design includes an increasing death benefit option and blending permanent and term insurance. I went over this in my IUL video. Again, you can check that out by using this link up here, and it will explain it in more detail. But essentially, when it comes to an index universal life policy, we have 2 options for a death benefit. We can do a level death benefit, or we can do an increasing death benefit. The way to maximize your cash value in these policies is by making sure it's an increasing death benefit option. And then also blending permanent and term insurance to cover the rest of the death benefit that you want. Now, when it comes to whole life insurance, the optimal design also blends whole life insurance and term insurance. We want to have the base premium, which is built on the whole life product. We want to have that base premium as small as possible compared to how much we're going to be paying in. But in order to do that, the government requires us to have a specific death benefit. So in order for us to get to that death benefit, we're going to add in some term insurance to cover some of that death benefit. Remember, term insurance is very cheap insurance. When we blend them correctly, we end up with the smallest amount possible going into base premium and the rest of it going into the term insurance, which is what buys us our paid up additions. And the paid up additions is essentially cash value in the policy. And our last difference is in an index universal life policy, at maturity, your death benefit ends up matching your cash value. The way these policies are designed is eventually your cash value and your death benefit are going to match at some point, which is typically around age 95. Okay, now something to keep in mind. This is only in an optimally designed policy that those end up matching. Because if we design them to eventually come together at those high ages, 80, 85, 90, if those are far apart, the cost of your insurance is going to be immense. So we want to design them to get closer and closer as you get older. That way the cost of insurance is not going to skyrocket. The amount that you're paying in insurance is going down and down and down each year. as that cost of insurance goes up, up, up. So the way that we do that is we design it so that the death benefit matches the cash value at maturity. Now, with the whole life insurance, it's totally different because we're buying paid up additions, which means the death benefit will always be more than the cash value. So if you start off with a $1 million death benefit in your whole life policy and you've been buying paid up additions, maximizing that cash growth, you're going to have way more than $1 million death benefit when it comes to the policy maturing. And that will be way more than what your cash value is at maturity as well. Those are the main differences between an index universal life policy and a whole life policy as we design them for infinite banking purposes. So I hope you found some value in this. If you did, be sure to hit the like button below. If you have any questions or if you think there's something that I missed, put them in the comment section below. I'd love to talk with you about it. Thanks for watching.